Now, our market watcher for today, Patrick Ejumedia, Head of Research at Sterling Asset Management and Trustees, is still with me in the studio for a market review of trading at Nigeria's stock market this week. Thank you, Patrick, for staying with us. Now, of course, so with the 50 basis point hike in the MPR, we're going to see cost of financing obviously increase. So where does that leave quoted companies on the NGX who are looking to increase their cash?
Okay, so first is whatever is happening in the market now is probably because the lag effect of the previous hike that the government has done before. So what has happened now may not immediately start affecting the markets, those companies in the market. But basically what you said, like you've mentioned, is to increase the cost of financing. An increase in cost of financing would definitely drive profits down.
Right.
And by the time profits goes down, it affects their return on investment. So for investors who have invested in those companies' stock, their return goes down. And by the time their returns go down, it discourages them from buying. So what you then see is that people no longer buy those company stock that are particularly sensitive to interest rates. So you see moving from those type of company stock to companies who are less sensitive to interest rates.
So how much volatility is that going to be creating in the market?
That volatility has to be there as long as...
Oh, we're seeing there's volatility.
Yes, you've seen it. So if you look at the stock market movement now, you see it's going up, particularly for this month. Although this month, month to date, we've seen some positive value of about 2%, but it's still very volatile. We have more positive. But with this rate now, we might also be seeing the volatility continue like that, as people will be moving from the companies that are interest rate sensitive to the ones that are less interest rate sensitive, and particularly those ones that have, let's say, inelastic demand for their products.
And of course, there's also the fixed income market where we're seeing higher yields on the one-year treasury bills.
Just at about 20%.
So where does that leave the market in terms of the trend you're expecting in the next, say, 2-3 weeks? Is this going to be a trend that will continue until then, or?
Yes. Basically, that's what's going to happen. Already, if you look at the sectors now, most of the sectors, the banking sector that has been doing badly, negative growth for most times of the year, is now turning positive. So the oil and gas sector is now doing well. Then if you see the industrial goods sector that was doing very well, particularly from the beginning of the year, is now coming down. So two main sectors are driving the market now, which are the banking sector and the oil and gas sector. And like I said, it's because of, one, the fact that the products that they are producing are inelastic, one. Then secondly, they are less interest rate sensitive. So because of their products, if they borrow at high rate, what happens is that they can shift the cost to whoever is buying. So your fuel, you must buy your fuel. So if I borrow and the cost of fuel is going up, I sell the cost of the fuel to you at a very high rate. You buy, I make my profit. So you can shift the product to whoever is the cost of the product, the cost of borrowing to whoever is buying.
Well, that's interesting. We'll see how this plays out in the coming weeks. Thank you so much, Patrick, for talking to us today. Appreciate your time on the show. Patrick Ejumedia, Head of Research at Sterling Asset Management and Trustees.